The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A cautious calm as the S&P barrels toward the longest winning streak since May. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. A steady march higher in stocks.
Another record high, though,
Another
right?
record high, right? Fifth straight day of gains for the S&P 500 and a fifth day of record highs as well. Up half of 1% right now, just under that 63.91. I was going to say below 63.90, but we rose above that. All right, VIX is just at the low 15s, and of course it is at a fresh 5-month low. There's not a lot of demand for hedging, at least at the index level. And what you're seeing is people starting to talk about maybe being in bubblicious territory. The yields are doing nothing right now. Bloomberg dollar index slightly higher right now as you had a fairly benign meeting between Fed Chair Jay Powell and President Donald Trump yesterday.
Let's check in on investor sentiment, Scarlett, because when we talk about that grind higher, we need to point out that after being bearish for most of the year, the bullish sentiment is decidedly back. In fact, swelling for a fourth straight week relative to the bear case. And that's the longest streak that we've seen of weekly bullish sentiment gains in that American Association of Individual Investors survey all year long. Now, while resilient economic data and corporate earnings justify the optimism, the tariff and policy risk may not.
The market has pretty much gone to sleep on the tariffs, whether it's 10% or 15%. And I think we're going to have to revisit that one day. But for now, we're in a place where whatever happens with the tariffs, whether it's August 1st or not, there's a lot of, the sky is falling, but the market's not seeing it this way.
Well, and it's a great point, because as economist Hyman Minsky famously hypothesized, periods of stability often foment periods of instability. Bank of America's Michael Hartnett providing Exhibit A, seeing risk of an equity bubble if monetary policy actually starts to loosen alongside a loosening in financial regulations. And I'll quote him directly: bigger retail, bigger liquidity, bigger volatility, bigger bubble, end quote. Now, we certainly have the first two. Liquidity, the amount of spare cash flowing around the U.S. financial system, that's well above every historical market out there. And retail traders, they've accounted for much of the rally off of those April lows and contributed heavily to the remanifestation of the meme stock media that's pushed Kohl's, Krispy Kreme, GoPro, and some tiny healthcare company I never heard of to just incredible highs.
Yeah, pretty remarkable moves for the 1 week period. So yes, massive moves for some individual retail traders' favorite names, but for the broader market, we've now gone 4 trading weeks since the S&P 500 closed more than 1% higher or lower. You have to go all the way back to June 24th. That was when Fed Chair Jay Powell offers balanced comments on the prospect for rate cuts. Of course, there's been no shortage of headlines from President Trump since then, whether he's slamming Powell for not cutting rates now, threatening new tariffs, or announcing trade deals. According to Bloomberg Markets blogger Ed Harrison, this muted market response to Trump-related news shows that traders are treating economic data as a signal and increasingly dismissing White House developments as noise. Romaine?
Brian Nick joins us right now to kick us off to the close on this Friday afternoon, head of portfolio strategy at NewEdge Wealth. And Brian, as you take a look at a market that is setting up for yet another record high, is there credence to this idea that maybe things are a little bit stretched?
We definitely think so. Positioning is not stretched. Positioning has gone from very, very light in April to about average now. And I think it's fair to say that the story of 2025 so far has been the pricing in and now the gradual pricing out of a deep, deep recession that kind of climaxed at the Liberation Day moment in April. And the risk seems to have been tapering off since then. And stocks are responding to that. But things like how much of, say, non-profitable stock trading is being done by retail, that is hitting a multi-year high. How much speculation are we seeing in markets? How much trading is being done for purely speculative reasons? We're seeing that start to hit very, very high levels as well. And the high beta trade, how many people are going after the riskiest stocks in the market? That's also close to the 99th percentile in terms of the recent performance. So there definitely are signs of froth. We just aren't seeing the broad-based positioning aggressiveness that we would need to see to think that something was imminent in terms of a correction.
Should we sort of read into that froth, if you will? And I mean, let's just take the meme stocks, or whatever we're calling meme stock these days. 30% gains on the weekend. Krispy Kreme, 50% on GoPro, which I didn't even know was still publicly traded. And of course, Open Door Technologies, which is, tripled, quadrupled in value just over the last couple of weeks here. We've been here before, and that did in the past signal a bit of a top in the market. Does history repeat itself?
It's certainly rhyming right now. You don't have to go back too far, as you referenced. 2021 was really the time we were seeing this meme stock phenomenon. We're calling it the silly stock phenomenon. The difference is that the liquidity provisions that we were seeing at that time were massive compared to what we're seeing now. We have gone from a period of shrinking money supply to growing money supply, but over the last year, M2 growth is only up about 4.5%. Most other measures of liquidity are not anywhere near as astoundingly high as they were in 2021 when the Fed and basically every other economic policymaker had come in with unlimited amounts of liquidity to help the economy at that time. So we shouldn't be seeing the same type of behavior in the markets, this liquidity driven sort of fervor, fad stocks, that kind of thing. But to the extent that we're certainly cautioning against kind of chasing those trades, chasing that very high day-to-day volatility. And as you pointed out at the beginning of the show, overall market volatility has been very, very low. It's just these stocks that are sort of popping 30, 50, 70% in one day. You often see that at a time when the VIX is at 15 or below and starting to fall. You start to see these for lack of a better word, meme stock phenomenon start to grow up again.
What about Treasuries volatility? Since the election, the 10-year yield has pretty much remained between 4% to 4.75%, with a brief foray below 4% right around early April. What causes a breakout there?
Yeah, I think it's important, as you put it, the election was really the big catalyst for the 10-year. We've been in that sort of the 4 to 4.5% range, a little bit higher, a little bit lower at times since the election. We know before that, the summer of 2024, when the Fed was cutting rates and the election outcome was still uncertain, we were in that 3.5 to 4% range. And for the 10-year Treasury, that can be a big difference. For mortgage rates, that could be a big difference. But there's a number of things getting priced in here. Certainly the questions about what the Fed's going to be doing with interest rates and how independent the Fed is going to be acting with respect to interest rates, that has a steepening effect on the yield curve. We think the weaker dollar also tends to be on the opposite end of the seesaw from potentially higher interest rates if there's an increasing inflation expectation there as well. And just the general amount of stimulus that we're seeing on the fiscal side, I think that the passage of the One Big Beautiful Bill Act also maybe cemented the idea that we're going to be in a somewhat higher interest rate environment for the time being, as investors see just how big the debt cost of that bill is going to be.
That's the key phrase, right? For the time being. If there is a rate cut from the Federal Reserve and it's triggered by weaker economic data, that can't be good news for equities or any risky assets.
No, we've been telling our clients this for a while. Anybody who's hoping for rate cuts is likely hoping for a higher unemployment rate or just an overall weaker economic story. And the economy is not growing very fast right now. Underlying economic growth in the first half of this year was probably about 1%. Maybe it's picked up a little bit with some of the high frequency July data. But should the Fed be cutting later this year in sort of a drastic way, because we've seen the unemployment rate go to, say, 4.5%, that would not be good for the equity markets, and certainly not the parts of the equity markets right now that are screaming for rate cuts, like home builders. You would, I think, in that scenario, see Treasury yields fall. The scenario where the Fed cuts rates and the market doesn't exactly buy that now is the time to be cutting rates, you could actually see the Treasury market rebel, and you could see the 10-year yield move up. We've seen that in other countries where central banks seem to have cut rates in a sort of a preemptive way. And even since the Fed rate cuts last summer, net, as you pointed out, the 10-year really isn't that much lower.
Hey, final question, Brian, and this is more about portfolio construction. There's been a lot of discussion about this idea of how you diversify a portfolio in this environment, and even just beyond the traditional use of fixed income. Obviously, the use of alternative assets and specifically private assets. Is that something that you are meaningfully advocating for right now to your clients?
We are absolutely pounding the table for our clients who tend to be higher net worth in nature. We talked at the beginning of the year about uncorrelated assets, different types of hedge funds, private vehicles that don't have much of a market correlation. We thought that was really important coming into the year with valuations as high as they were. Now they're back to where they were at the start of the year after that swoon in the spring. We're also talking about things like private infrastructure, which are not necessarily uncorrelated, but deliver sort of higher, steadier rates of return, and you own a real productive asset that could be connected to a major investment theme like AI generation or clean energy. And those are other options that investors who can be in the private markets have. At the end of the day, though, in a severe recession scenario, the Treasury market and other high quality fixed income is going to be the best game in town. It's just been really hard to make that argument since we haven't seen that kind of dire economic scenario really outside of those first few weeks around COVID in the last couple of years.
All right, Brian, great stuff. Have a wonderful weekend. Brian Nick, head of portfolio strategy at NewEdge Wealth, kicking us off to the close with the majority of stocks in the S&P solidly in the green as we move towards those closing bells. A conversation up ahead about the luxury retail space. A conversation with Pauline Brown, the former LVMH Chairman of North America, going to be joining us to talk about the most recent earnings as well as that report just crossing the Bloomberg terminal about the potential play for Marc Jacobs.
Plus, the CEO of Onsemi, America's largest power semiconductor manufacturer, joins the program to discuss the growing energy demand to power the next leg of the AI race.
And speaking of AI, well, how about powering it to your credit score? Silvio Tavares is the CEO of VantageScore. A conversation up ahead about competition heating up in the space. Stick with us. This is The Close on Bloomberg.
Aon is one of the S&P 500's top performing stocks today, headed for its best day this year after the insurance giant beat earnings estimates. Aon credits the global uncertainty that has plagued companies in other industries as driving steady revenue growth. So joining us now live in studio is Aon Executive Vice President and CFO Edmund Reese. Edmund, great to see you.
Great to see you, Scarlett.
So investors were impressed by the 6% growth you booked in organic revenue last quarter and your commitment to increase that by the mid-single-digit percentages for at least the next 2 years. How exactly does global uncertainty contribute to organic growth?
Look, this is an exciting industry to be in right now. It's over $5 trillion, nearly $5 trillion, and growing at strong levels. And we sit in a unique seat where we see corporate balance sheets and corporate income statements, and there is uncertainty, complexity, volatility. CEOs and CFOs want predictability on their income statements. We provide the solutions, the analytics that help them measure risk, help them determine what they're going to retain versus transfer out to other capital providers, and also help bring capital in. That gives them predictability on the income statement and the balance sheet, and that's what our solutions are doing. And that's where we saw growth in the quarter to drive this kind of performance in Q2, so we're pleased with that.
You provide insurance brokerage services. I'm curious how the dynamics in primary insurance differ from those in reinsurance right now, because I wonder if demand is comparable and whether it's more a reflection of your ability to provide tailor or bespoke solutions to certain parts of that.
Yeah, it's an excellent question. First of all, both grew at 6%, so we're pleased with the growth and both of them. In reinsurance, to the point that you're making, demand continues to be high, and we're bringing in new capital solutions. That's the good thing about Aon's analytics. We help bring in new capital into the marketplace. So reinsurance was growing not just from the traditional areas like what we call our U.S. treaty or facultative insurance companies getting reinsurance from other insurance companies, but also from other insurance-linked securities. Our cat bonds, parametrics, those things grew at double-digit levels for us. The cat bond market now is nearly $50 billion outstanding. Insurance-linked alternative securities are $110 billion, and we're a leader in that space.
With some of the smaller units, I mean, what is the growth strategy that you and the CEO have articulated with regards to the wealth business, the health business, et cetera?
Yeah, well, first, health grew at 6% as well. That's a major category. Health is now becoming nearly 20% of the U.S. GDP. It's growing, at a double-digit level. We talked about 18% growth in that space. Companies, you've heard me say before, the 4 areas of uncertainty, the mega trends, workforce is a part of it. So helping companies understand their claims data, their workforce data, helping them have new health and benefit solutions, that's a strong area of growth for us. Wealth as well. I mean, wealth in the U.S. in particular in this past quarter, pension plans and how you insure those or reduce the risk and the volatility of that may have slowed some. The uncertainty, again, might have companies pulling back. But the regulatory nature, the complexity that our international markets, UK in particular is one that I'd call out. We actually saw our wealth business grow very strong in the UK market as we help companies deal with what we call pension risk transfer.
Yeah. With regards to some of the other risks out there, maybe you can talk a little bit about technological risk. There's been a lot of talk over the last few days about this hack involving Microsoft software. Obviously, with the whole proliferation of AI, there's a lot more concerns amongst corporations about not only protecting their data, data, but making sure they don't get sued for or lose any lawsuits related to any breaches or things like that. Are you seeing more activity and more interest amongst clients
Absolutely.
on that level?
Trade is one of those four. I'm sorry, technology is one of those four megatrends that we talked about. I think the last time I was on this show, I talked about cyber associated with that being approximately about $20 billion in insured losses, but that was only about 12% of the losses. So that was a key growth area for us, again, both in the U.S. and in international markets, number one. But something else that I called out on today's call was our growth in construction, our growth in
the construction.
Data centers construction for technology.
It all comes back to data
If
centers.
you think about that, it's a booming environment. We opened up a new facility for it right now. It's one of the fastest growing areas. We had double-digit growth in that. And I would say infrastructure projects, other technology projects associated with data center and cyber is one of the key areas of growth for us.
Edmund, you're in the insurance business, so you've always got one eye, looking at potential problems. What are you most worried about right now? Well,
look, I'm also a CFO. The same thing that I'm hearing from our corporate clients is really trying to get some stability in the market right now, and I think there's some steps to it. One of the bright spots was us starting to see some of the M&A activity starting to pick up. I think investors and some of the analysts thought that maybe it has already arrived. I think there's still some time before we get there, but getting some stability, whether it's through the big, beautiful bill or whether it's through sort of settling some of these tariffs, I think that's a concern of mine. That's a concern of the CEOs and the CFOs that we're working with. When you get that stability, then you're ready to invest for growth, organically and inorganically. And that's what we're focused on for us and for our clients as well.
All right. Well, Edmund, investors obviously like what they heard today. Hopefully you can keep that streak going. The stock having its best day going back to at least October of last year. Aon Executive Vice President and CFO Edmund Reese right here on the close. One of the biggest gainers in the S&P 500. When we come back, we're going to focus on one of the biggest losers in the S&P 500, and that is Intel. A recent report yesterday overshadowed by the conference call with the new CEO. Some concerns here that he's too focused on cost cutting and not enough on innovation. That's coming up next here on The Close. This is Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. And we start with Carvana, with Oppenheimer revving up their rating to outperform, setting a $450 price target. The analyst saying the used car dealer will start, quote, generating meaningful cash amid improving demand. The share is up 1%. Next up, Estee Lauder. JP Morgan upgrading the cosmetics company to overweight, lifting the price target to 101 from 62, expecting a positive surprise on the revenue side when the company reports results in just about a few weeks. Those shares up about 3% on the day. And finally, Molina Healthcare, Truist downgrading to hold, slashing the price target to 180 all the way from 335. Cantor Fitzgerald also piling on in the wake of the health insurer's results that featured the second cut this month to the company's outlook. Nevertheless, the share is actually getting a nice bid on the day, up about 4%. Of course, that does not get back to the big losses from yesterday. All right, speaking of earnings, we're also keeping an eye on Intel. Those shares down more than 9%. Joining us right now to talk a little bit more about what we learned out of that earnings report yesterday is Matt Bryson, Managing Director of Equity Research at Wedbush Securities. And Matt, we were talking to you yesterday as those numbers came out. We didn't actually talk after that conference call, a conference call that seemed to, I guess, rattle a few investors because they seemed to feel that Lip-Bu-Tan was focusing a lot more on cost cutting and less on innovation and technological progress. What did you make of what he had to say?
Yeah, definitely. It's a different story. Pat was all about unbridled optimism. We're going to outinvest, and because of that, we're going to have a better product. With Lip-Bu-Tan, it looks like Intel's being far more pragmatic. We're not going to invest unless demand is there, and we think we can compete in the market. And obviously, those are two very different strategies.
Is that a good thing, though? I mean, because when you look at some of the other companies and the way that they're spending, there's been a lot of criticism that it is, for some of those companies, kind of just throwing money at the wall and seeing what sticks. Is there sort of a bull case for pragmatism at Intel?
It could put them in a better place. Like, clearly, with them writing off some of their investments, they were overspending, and no one wants to throw money away. At the same time, under Pat, the promise was always, we're going to be the Intel of old. We're going to have 90% share, 65% gross margins, that's not what you get if you're just a competitor. I mean, look at AMD. They've got low 50s to mid 50s type gross margins, and for them, they're killing it. And so very different end game if you're not gonna try to be the clear leader again.
Okay, well, I mean, Tan had made clear that he plans to keep Intel's manufacturing and product design businesses together, but is he managing the company in a way to just shrink it down and perhaps simplify it?
I mean, certainly they're simplifying it. Look, you had the story today that they're looking at getting rid of their networking business. There's nothing wrong about just concentrating on your core competencies. Kind of the question with Intel, however, is can they execute on those core competencies? Because that's where they failed, right? They failed in manufacturing for decades. They were the leader in high-end chip manufacturing. They failed in chip design on the compute side for both servers and PCs. Again, they were 95% of the market for forever there. And so the worry is you just can't get that back.
Yeah. How much leeway will investors give Tan?
I think they have to give him a lot of leeway, just in the sense that you've gone through Pat Gelsinger, who was going to save Intel. You've gone through multiple executives before that. You had someone focused on finance. You had someone focused on products. I'm not sure if Lip-Bu Tan doesn't work out, I'm not sure where you go next.
How much of a runway do you think the company has with regards to their current product mix? I mean, I know there was a bright spot in the most recent quarter with regards to PC sales, and I don't think there's any investor out there that thinks that's a sustainable for the future. But could it potentially be enough to maybe buy Tan a little bit of time while he tries to make this transition?
I think, unfortunately, with PC sales, a lot of that came from pull-ins, companies buffering their inventory ahead of potential tariffs. Now, having said that, Intel has a new product set coming out in Q4, really ramps in Q1, called Panther Lake. That's on their own internal manufacturing. And that's kind of what Pat had been geared towards, that first 18A product. And if that works out, I think that does get Intel some time. But we just don't know until the product starts shipping what they really look like.
Matt, just real quickly, any possibility that this becomes an M&A play?
I mean, I would never say never. I think the problems are you need other nations to allow Intel to get sold, split, and China has kind of been reluctant to okay mergers.
All right, good stuff. Matt Bryson, Managing Director of Equity Research at Wedbush Securities. We know at least one potential suitor, TSMC, is no longer interested in Intel.
Yeah, and that would, let's just say, be complicated in this current political environment.
All right, coming up, we're going to speak with Pauline Brown, former LVMH Chairman of North America, about her outlook on the luxury market given all the uncertainty around tariffs. This is The Close on Bloomberg.
3:30 p.m. as the clouds roll in over a hot and humid New York City. This is the countdown to the close. I'm Romaine Bostic.
And I'm Scarlett Fu. We're staying cool here in the office. There's a lot of rumblings about moves in luxury retail. And in particular, the Wall Street Journal is reporting that LVMH is in talks to potentially sell Marc Jacobs, one of its brands.
Yeah, that's kind of interesting for a couple of reasons. I thought Marc Jacobs was still hot and still profitable. But it also raises this whole question about what they are trying to turn LVMH into.
Yes.
I mean, obviously, they have some of the most outstanding legacy luxury brands out there. But some of them, they've just kind of fallen out of favor. You know, maybe they've gotten a little oversaturated in terms of their being too far into the zeitgeist. Maybe the cost of them has just gotten a little bit too high. And at some point, you have to find a way to rejigger things, and maybe selling off some of the brands might be the answer. Yeah,
LVMH, really a luxury conglomerate with the number of brands it has under its house. And of course, it can kind of deploy that as it sees fit. So let's bring in Pauline Brown, former LVMH Chairman of North America, to give us a sense of what's happening here across the luxury retail space. Pauline, great to speak with you. Just to get your quick comment here first on LVMH in talks to sell Marc Jacobs. Is it doing this because, or holding talks to do this because it has to, or because it sees an opportunity?
Well, it definitely doesn't have to. As tough a quarter as it was, and as tough, I would say, as 18-month period as it's been, and perhaps another 18 months ahead, it's still a cash-rich company. There's still 75 brands, of which many of them are delivering on the bottom line, and to a much lesser extent right now on the top line. So it doesn't have to do anything. I do think, though, this 75 count in terms of the portfolio is getting very full. And the complexity that that's leading to, coupled with the fact that fashion is actually a very unprofitable business for them. Even within fashion and accessories, if you look at the breakdown, a brand like Vuitton, which is highly profitable, is making all of its money from the non-fashion portion of its sales, which is accessories.
So fashion being a very unprofitable part of its business, does it do anything to fix that, or that's an acceptable loss leader as long as it can bring it in on the other parts of the business?
For a power brand, a Chanel, a Vuitton, it's acceptable. These are essentially marketing expenses, putting on fashion shows, producing a ready-to-wear line, even more painfully producing a haute couture line. But for a second or third tier brand, I would say in the long term, it is not sustainable. It is why so many independent fashion brands end up going out of business after a while unless they're acquired. Marc Jacobs has been part of the group for a few decades, but it is hit with competition from a lot of younger brands that also have that heavy fashion orientation and are probably appealing to Gen Z and young millennials to a much greater extent.
I am curious, Pauline, when I was looking through the release yesterday on LVMH, what's the issue right now with regards to pricing power? It always seemed to be like this mechanism that they had, that they can flip that switch, raise prices, and protect the bottom line. But there does appear, and I don't know if it's specific to LVMH, but there does appear, at least in the broader luxury space, to be some pushback by consumers on some of those price hikes.
Yeah, well, I think there are two issues. First of all, this is not specific to LVMH, but they were one of the more aggressive ones when it comes to certain one of their fashion brands. I'd say Dior being the most extreme example. Chanel, though, as well. In the case of some of their bags, they rose as much as 50% over a 3-4 year period. They could get away with it during the 3-4 year period because sales of premium brands were very robust. But at this stage, the consumer's gotten a lot more demanding. There's a lot more competition for their spending. And I think that for many of these houses, they've stretched that rubber band just too far. So even very wealthy people who are not affected by the market, not affected by housing, are saying, is it even worth it vis-a-vis maybe a Cartier necklace?
So with regards to the fashion aspect of it, or I guess maybe the aesthetic of it, the idea of if you bring in a new designer who could bring sort of a fresh sensibility to that, and I know we've had announcements on Dior, Celine, LeVay, Givenchy, and then I know over at Kering with Gucci and a few others. Does that help when you bring in a new designer like that who can create some buzz and hopefully sales?
It can help. It's a bit like casting for a movie. If you cast the right star and it's a hot star and a talented star in the right role and all the other pieces come together, it's like magic. This is a business that's driven on cultural relevancy and on a certain entertainment factor. I think the challenge is that there are so many new buzzy designers in so many seats right now, and it isn't working in the case of several of the brands. In the case of Dior with Jonathan Anderson, who is a very buzzy brand or buzzy designer, it very well may work. It's too early to tell. But you take someone like Alessandro Michele, who had for many years done a stellar job at Gucci and now moved over to Valentino, and that is clearly not working. So whether it's because the consumer's fatigued, whether it's because they're moving into other categories altogether, like sports and forms of entertainment, or whether it's because the casting hasn't been as strong in this latest iteration, I can't tell you. All I can tell you is that the return on that investment doesn't seem to be going as well as we've seen in years and decades past.
Another drag on LVMH, certainly on the fashion business, is the ongoing slowdown taking place in China. It's a macro factor, but it doesn't seem to be a macro factor that is dragging down standalone brands like Hermes or Prada. Why is that?
Well, one is those brands, particularly Hermes, Brunello Cucinelli, even Moncler did quite well in parts of Asia this last quarter. They're standalone, they're disciplined, they're simpler organizations and operations. I think one of the things that helped LVMH for so many years, its breadth, its depth and breadth, its diversity of categories and of nameplates. It's now leading to a level of complexity that is making it much harder to compete with those that are more agile, those that have really focused on what they do well in a singular way. But I would say that the Hermes and the Pradas, the Brunellos, They are exceptions. What we see with LVMH, what we'll probably see next week with Kering, they're more the rule right now in a very, very unforgiving marketplace.
Right, and this unforgiving marketplace being marked by this kind of fatigue towards luxury fashion in general. How do these big companies like LVMH, like Kering, solve for that?
Well, I think, look, they've always looked at this as a portfolio play. And if you take some of the bigger brands like LV, they probably should be driving that one for value and not for growth. It is already so big, multiples bigger than the number 2 player in the sector. But I do think within the group, there are a lot of underdeveloped brands that still have rich heritage, a lot of goodwill, deep history. So I think if they can pick some good horses that they're going to nurture over time and they show a certain amount of patience, the industry is not going away. People will not stop buying luxury. But they are becoming more and more discriminating about what they perceive as luxury. And I think if LVMH is trying to grow everything and under the scrutiny of a public market, I think they're going to have a very, very tough go. These are not typically companies that can be run for the quarter and run simply for commercial return. They really have to think about the brand equities and how to protect that and how to take it over the long term.
All right, Pauline, always appreciate you taking time for us. Pauline Brown, former chairman of LVMH's North American operations. The LVMH, of course, just reported earnings a couple of days ago. We're going to get Karen, the owner of Gucci, set to report this upcoming Tuesday. All right, when we come back after the break, we're going to focus in on, well, cable and internet. Charter Communications, one of the biggest decliners on the day. This is after the company said, well, maybe not as many people are holding on to their internet connections. It's our stock of the hour, and it's coming up next. This is Bloomberg. All right, a little bit earlier we were talking about Intel, the second biggest decliner in the S&P 500. Let's talk about the biggest decliner. It's Charter Communications, having its worst day on record after the TV and broadband provider actually said that they're actually seeing a significant decline in the number of folks connected into their internet business. Chris Palmieri joins us right now, media and entertainment team leader for us here at Bloomberg. I'm a little confused, Chris. I mean, we knew there were troubles with regards to the cable side of the business, but why would we be seeing softness when it comes to the broadband side?
Right. Yeah. We know we've all been canceling the cable cord for TV, and the big cable company said, don't worry, we still have internet access, and that's a huge business. You still have to have it to watch Netflix. The problem is the telecoms that were, sort of losing in the overall internet access game for years, talk about AT&T, Verizon, and that, have really upped their game. So they're putting fiber optic lines closer to home. They've got new wireless internet access they're offering. And because the cable guys no longer have the cable TV thing that keeps everyone kind of bundled, it's sort of up for grabs. Subscribers are switching or signing up with telecom companies. So it's a big problem when you're losing 100,000 subscribers a quarter. Yeah. In your core business. That's the reaction we're seeing here.
Yeah, and of course, all those mobile phone companies are offering deals to bundle with their existing mobile phone plan as well. So here's my question. Charter has a pending merger with Cox Communications. Does that solve for any of this?
Well, often you kind of scratch your heads in deals like this. It's like, oh, we'll just get bigger in the same business that we're struggling in. But presumably, I mean, they're Charter's number one already with the Spectrum brand. This is going to give them a lot more heft. They can cut costs. They can potentially use their, power to negotiate better deals with providers. One of the things Charter's been doing is very interesting is they give away all these streaming services. They've negotiated deals, with Disney and Warner Brothers and Paramount. So it's not a bad price. Your regular cable package comes with all these streaming services. And so that's mitigated some of the losses in cable TV customers they've seen, but it hasn't stopped them. So they're presumably going to do that with the Charter folks as well.
I know, this kind of gets into speculation, Chris, but there's been a lot of talk, not only with Charter, but Cox and a few others, this idea of whether there needs to be a little bit more M&A in this space to address some of the issues, not necessarily just on sort of a horizontal basis, but the idea of whether maybe these companies get back into the content game directly. Is that just absurd?
Yeah, it seems like we've all watched the various machinations of Time Warner Cable. We're now seeing Comcast spinning off its cable channels. I don't necessarily see a whole big merger of content and cable right now.
Oh, okay.
Chris Palmieri, Media Entertainment Team Leader at Bloomberg. Thank you so much. And Romain, that gets the idea that, like, remember those days when you'd have to call up your cable provider and renegotiate a deal, tell them that you're canceling, threaten to cancel, and then have them offer you something better? Yeah, it was a nice game I played every year. It's like, just a holiday. You just basically, all right, this is the weekend. We're going to go down. Yeah, you're going to devote a couple hours. Haggle and play this game. I had no idea how they stayed in business. All right, coming up, we're going to take you to the closing bell with Katherine Bordlemay. She is Managing Director at Goldman Sachs Asset Management. We'll talk about what's going on here with the S&P 500 set for its 5th straight record high in 5 days. This is The Close on Bloomberg.
Should the Fed be cutting later this year in sort of a drastic way, because we've seen the unemployment rate go to, say, 4.5%, that would not be good for the equity markets, and certainly not the parts of the equity markets right now that are screaming for rate cuts, like home builders.
Brian, Nick over at NewEdge Wealth kicking us off to the close just about 50 minutes ago. Scarlett, an interesting week that we saw here. It was a very busy week, of course, with regards to earnings, but obviously a lot of concern about macro conditions and, of course, whatever the heck is going on between Trump and Powell. But the market took it in stride. We got green across the screen on the day and for most of the indices on the week. Taking it in stride is pretty much what's been happening since early April, right? You look at the S&P 500, up 0.4%. It's just been this steady move higher this whole week. 5th straight day of gains. And within the Mag 7 names, you've got Tesla rebounding sharply from yesterday's deep sell-off. Most of those names are higher. We get more of the Mag 7 names reporting next week as well. Absolutely. Next week is going to be a really busy week, the busiest week of the earnings season, with something around 160 of the large cap companies reporting, including 4 of the 5 biggest weightings in the S&P 500. Katherine Bordlemay joins us right now. She's Managing Director at Goldman Sachs Asset Management as we march towards those closing bells just about 9 minutes away. And I do want to ask you about this earnings season. I mean, we're really getting into the heat of it next week with, the Amazons and Microsofts and Apples of the world. But we've gotten a taste so far over these last couple of weeks. And earnings have so far, I thought, been good. I wonder what you make of what we've learned so far and whether you think that's going to continue over the next few weeks. Yeah, so it's early days. We're only 20% through, but 80+% of companies have given us beats. So I think we're a good start. And if you think about the tech companies in particular, when they gave us guidance in April, I mean, this was really the heart of the fear. So I think the bar could be a little lower. So I think we're teed up pretty nicely, but let's see. When we talk about this rally that we've had off of those, pick the April lows or whenever, it has been relatively narrow. NVIDIA, Microsoft, like a quarter of the rally so far. And it doesn't really get much broader than that. Do you see the potential where we will see more broader participation in this rally, particularly when you get down into the mid-cap space and the small-cap space? I do think it will broaden out. Yeah. And you're right, the rally, I mean, it's been incredible. We've seen 3 years of returns in 3 months. And it brings us back to this very familiar problem, which you've highlighted, Romain, which is market concentration. The Mag 7 are 1/3 of the S&P 500. And on the go-forward basis, when we look forward, I do think the big will get bigger. So you want to continue to lean in there, but look beyond the Mag 7. And by the way, not just to the other 493, but really to the other 8,633. And we would look across our team around the world, I think our highest conviction view to diversify is going down and out. When you say down and out, you're talking about down in size, so that would be small caps and out, meaning globally beyond the U.S. What are going to be the catalysts, though, for small caps to really break out in a way where they can sustain that advantage over big caps? Yeah, so we've started to see them come back a little bit. So we see a little life month to date. Small caps are outperforming large. And I think longer term, the setup's pretty interesting. If you look at small caps, compare them to large, we're expecting double the earnings growth at half the valuation. But to your point, Scarlett, we need those catalysts to come through. So what do we need? 1, good, healthy U.S. economy. And 2, we need the Fed to potentially start lowering rates. Both of those things are coming together in the back half this year. And number 3, capital markets activity are coming up. We've seen 100 IPOs this year, and M&A activities should come up too. So this is a great setup. You're a fundamental investor. When you talk about lower rates, where are you looking to see that
filter through to the bottom line? I mean, it sounds like financials would be an obvious play there.
Yeah, it's financials, which is a big part of the benchmark, and that matters. But I think it's really beyond that. I think maybe taking a step back, if we're thinking too, also what we really like. What we don't like is actually the index, because 1/3 of those companies are not profitable. So that's not going to help us generate long-term wealth. But we do like financials. We liked companies that are linked to the AI theme. AI is a revolution. The big are going to get bigger. Mega cap's going to be a big driver of that. But you're going to see other parts of that through the small cap market as well.
Is there an opportunity to ride the AI wave and really just the overall structural trades that we're seeing in the U.S. market? Does any of that translate to some of the major markets outside of the United States?
Absolutely.
Yeah.
And there's a lot of quiet winners of AI, even Europe. A big theme we see in Europe is around this kind of powering trend around AI. And what's really nice, actually, when you put Europe in your portfolio along with the US, you have this really beautiful barbell. Because in the US, it's about growth, it's about the Mag 7 and tech. But in Europe, actually value is leading. And since 2022, European banks are outperforming the Mag 7, so great diversification.
Is there, but when we talk about what held Europe back for years,
Yeah.
it was this idea, or at least a perception,
Yeah.
that these weren't really, it wasn't really a growth economy, it wasn't
Right.
really a growth market, and if you wanted that growth, you basically had to be in the U.S.
Yeah.
and invested in tech or tech adjacent here. Yeah. Is there a growth case? I understand there's a
Yeah.
value case to be
Yes.
made for Europe, but is there a growth case?
There is.
Yeah.
And the catalyst here is unprecedented policy. So if you look over the next decade, Germany, which of course is the powerhouse, it's the biggest economy within Europe, is going to deploy 500 billion euro of capital. So we haven't seen that come through. We're going to likely see it come through for a while. So we could actually be at the precipice for a pretty powerful revival, which will take growth from very low to maybe not so high, but that inflection point of change matters.
How much defensiveness should you have in your portfolio? Or do you achieve that through value stocks in Europe, for instance?
You got to be balanced. So I think you want the mix of defensive, you want the mix of cyclical, and there are some really interesting defensive linked companies in Europe that are also going to benefit from this policy shift.
Okay. And in terms of where you want to be with something like alternative assets, crypto obviously having a big moment.
Yeah.
How are you thinking about that and where exposure to that might take away from?
Yeah, you know, it's interesting. I think it's early to see where that falls through. I think it's encouraging that regulators are embracing that. We haven't embraced it in a massive way for our portfolios, but it's something we're looking at very closely.
Catherine, great stuff. Have a wonderful weekend.
Great, thank you.
Katherine Bordlemay, Managing Director over at Goldman Sachs Asset Management, counting us down to those closing bells, which are just about 3.5 minutes away, Scarlett. And we talk about sort of this phenomenal run that we've been seeing in stocks off of those April lows. Everyone, of course, was completely rattled by Liberation Day in early April. We hit those lows April 8th, April 9th, depending on the index. And it's pretty much been a stair step higher ever since. I mean, a couple of bumps, but more or less just a straight up, and it looks like we're going to hit another record high for the NASDAQ and the S&P.
And you can add some frothiness to that as well, right? Because the Mag 7 came back, but now you have the return of meme stock mania as well. Bitcoin has been taking off as well. People are not talking about positioning defensively. They're certainly not taking on hedges if you look at the VIX, for instance. Yeah,
and we saw that note from Michael Hartnett and the strategist over at Bank of America raising this issue. And the one yesterday where there was a lot of talk from Deutsche Bank and Goldman about just no one's really hedging, doing downside hedges right now in any sort of material way. And is that a concern that you have to now factor in to any sort of bullish decisions you make?
Right. Well, anyone who has done so over the last couple of weeks has regretted it. So, you know, for now, there doesn't seem to be any impetus until it does. It works until it doesn't. Well, right now, I mean, we talk about an S&P set to close at a record high, up about 1.5% on the week. But it's kind of interesting. What you're not seeing participating are a lot of the big cap names. The Philadelphia Semiconductor Index down 1.5% on the week, for example. Blame Intel. Blame Intel. You can blame a lot of the other names in there as well. The FANG's down and the Mag 7 trailing by a significant amount on a weekly basis. As we break down all of today's market action right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through to that closing bell with the global simulcast. Carol Master, Tim Stenovic join us from the radio booth as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. on a record day and a record week, Carol Massar, despite all the volatility in between.
Yeah, absolutely. A lot of volatility. We're coming off our best levels of the session. We caught up with Rob Kaplan, former president of the Federal Reserve Bank of Dallas, now vice chairman over at Goldman. We talked about pressure on the Fed. We talked about next week's Fed meeting. He says he's not ready to conclude that it's time to act in July, which is pretty much what everybody's thinking. But he said maybe, potentially, it would be right to see a Fed move come September.
Yeah, we'll see what happens in August and what we hear from Jackson Hole. Certainly next week, the Fed on our radar. But what about Meta platforms? What about Apple? What about Amazon? What about Microsoft? They are all reporting next week as well.
And everyone's going to be looking at how much they commit to CapEx. Alphabet committed more, so there are some question marks about whether that's going to be good or bad. Is anyone paying attention to Michael Hartnett's warning about a potential bubble risk in equities? It feels like people are looking at that and saying, nah, not right now.
Yeah, absolutely. And we talk about the meme stock mania, which has calmed down a little bit over the last couple of sessions, but still, you're seeing some pretty healthy gains out of a lot of companies that, let's just say, to be diplomatic about it, don't necessarily have the fundamentals to back it up.
I keep thinking about Gina Martin Adams earlier in the week, Tim and I talking about her. These small moves that we're seeing, that maybe that could be a sign of some consolidation at higher levels for stocks. But time will certainly tell as we get through earnings, Remain.
All right, well, at least for the day and, well, for the week as well, it is a pretty bright day. 340 stocks roughly in the S&P are higher on the day, and that's enough to take it to another record high, closing just below that 6,400 level, up more than 25 points or about 0.4% on the day. The Dow Jones Industrial Average closing out the day higher by about a 0.5 percentage point, and that's going to be good enough for a gain on the week of about 1.3%. The NASDAQ 100 and the NASDAQ Composite each rising about 0.25% on the day, 1% on the week, and the Russell 2000 participating as well, 0.4% on the day, and on a weekly basis, Carol, it's going to close out higher by about 0.9%.
All right, back to the S&P 500 I go, guys. And we had some fairly broad-based buying today. Scarlett, 332 names in the S&P 500 to the upside, 167 losing ground for unchanged, at least as we settle in here.
All right, and let's take a look at what's leading the gains today. It's really a mix of cyclicals and, of course, big tech. You have materials and industrials, each gaining about 1%. Consumer discretionary up about 0.8%. And then on the flip side, energy lower by 0.4%. Communication services moderately lower.
All right, let me get to some of the individual gainers, if I may. And I feel like these are perhaps all things in Romain's life, but we'll have to see if that's true. Let's start with Deckers, because that is your number one gainer in the S&P 500. I definitely see some Uggs and some Hokas in his closet. Stock was up as much as 20% intraday, finishing the day with a gain of about 11%. But as I said, number one gainer in the S&P. Net sales for Ugg and Hoka surpassing analyst estimates in the fiscal first quarter. Ugg sales rising about 19%. Hoka sales increasing roughly 20%. Bloomberg Intelligence, our own analyst, saying that Ugg's momentum further validates their conviction about the brand's health, and Hoka outperform expectations as new product upgrades fuel demand. All right, also check out Remain's Home. You might find a Yeti or two in there. We have that stock up about 5.6% here at the close after a Betaville uncooked alert says the outdoor products maker may have attracted some takeover interest. You might remember back in May that the stock rose after Jefferies said that the consumer products company stands out as an attractive target for private equity. The report, though, in today's trade, citing people following the situation, identity of a potential buyer is unclear, though some of the people suggest a PE firm may be interested, so maybe a private equity play. And then
Wouldn't it be great if, like, Deckers just bought them? You carry around.
What are the synergies?
Your big, gigantic mug with your
hydration.
Actually, I think people who wear Uggs probably carry Yetis. Can I make that assumption?
No, they carry like Stanley Cups, right?
All right. One more thing that might be in Romain's driveway, a Tesla. Probably not. I'm thinking you're not a Tesla guy.
Who has a driveway?
Are you a Tesla guy?
Well, first of all, yeah, I live in Manhattan, so no, I don't have a driveway.
If you have a driveway, then well, I'm going with you to the Hamptons.
Yeah.
If you got a driveway.
You need a driveway for a
garage?
Tesla or garage because you need to charge it.
And who drives in the city? Come on.
All right, we all drive in the
walk.
city. I drive in the city. All right,
City bike from
all right. So Tesla was a top gainer. Number two gainer in the NASDAQ 100. Stock up about 3.5%. We know it was sold off yesterday following Tesla's report that came late Wednesday and Elon's warnings. Analysts, though, raising price targets for Tesla since it reported earnings. 8 changed price targets. The average change was up about 3%. 5 raised price targets by an average of almost 9%.
Wow.
3 cut their price targets by an average of 7%.
Wow.
And 4 analysts downgraded
Wow.
their investment recommendation. None
All right,
upgraded.
I hope yours are better.
Hey,
I actually got the two worst performers on a percentage
basis
basis in the S&P 500. Let's start with Intel. Shares down 8.5%. You guys know what happened yesterday after the bell. Intel CEO Lip-Bu sparked concerns that he's more focused on cost cutting than restoring the chip maker's technological edge. Check out what he said on the call. Quote, "I do not subscribe to the belief that if you build it, they will come." He was referring to future spending and the spending under his predecessor just over the last couple of years in building these facilities, some of which they stopped building and they slowed down construction.
I am curious, though. I know everyone's taking that as a negative, but is that potentially maybe a positive? I know there's been so much talk about how all these other companies are just spending all this money willy-nilly and not really seeing a return from it. Maybe a more pragmatic approach
I feel like Ian King said you got to spend, though, right?
Yeah, I mean, think about this. This is Intel. This was like the king of chip making back in the day.
Yeah.
It's a cyclical business, but Intel has completely missed out on this cycle. I mean, yesterday, this was before the bell came, before the earnings. This was a $100 billion company. It's now about a $90 billion company. The question is, what does it look like in its next iteration, and how does it compete with the big players out there?
I mean, the Bears would say that comment sounds like he's managing for a decline or through a decline rather than managing for a recovery, right? Or for growth.
I mean, that's what and that's why I think you saw the reaction today. So we'll have to wait and see. Remember, he's still a new CEO, so he's got some time for a turnaround. But we've been saying that about the last two CEOs as well. I think it's fair to say. Hey, also Charter Communications, this was the worst performer in the S&P 500 today. It had its worst single day ever, down 18.5%. This after the company said it lost 111,000 residential high-speed internet customers in the quarter that ended at the end of June. It was more than analysts had predicted. They're facing pressure from the rise of 5G from mobile companies and also fiber home internet offerings as well. And finally, taking a look at Pinnacle Financial Partners, down 12%, along with Synovus, down 12.5%. This after the companies agreed to an all-stock transaction valued at $8.6 billion. It'll combine these two banks in the U.S. southeastern market, but investors not liking the looks of this, at least today.
All right, let's take a quick look at yields. We did actually see some movement there, relatively modest movement to be sure, but to the downside, basically about a 1 basis point across the board here. And it gets to this idea of a little bit of stasis right now going on in the yield spaces. Everyone really tries to game out, guys, where we go next with rates, particularly in light of all the pressure from the White House on Jay Powell, which we all were here live on air yesterday.
Sometimes with hard hats, sometimes without.
Well, the hard hats just was like, I mean, chef's kiss. I mean, honestly. It's the best television we've had in years.
That moment in time is just like seared.
Yeah, absolutely.
Memory forever.
Do you think it would have been as funny if they weren't wearing the hard hats?
No.
No,
Exactly.
it was only compelling because of the hard hats.
No, the paper made it. The paper was what made it compelling to me.
Has anyone seen that paper? Is that going to be like in the presidential library like years from now?
In the Smithsonian?
And was anything on it? Was it like the grocery list?
Yeah,
bread,
Powell
milk,
referred to it. He said the reason the cost has gone up, in your view, to more than $3 billion is because of the additional building that, construction finished, he said, 5 years ago on this, that he was now including in this assessment.
Yeah, and he was talking about basements and garages and things that, I don't know. I mean, I know he's a real estate developer, but,
it's too bad SNL is not on right now because I feel like they would have had a field day with this.
I mean, I feel like we're post SNL at this point. This can't even be lampooned, right? I mean, it's like reality is now.
No, it's
the
perfection already. Like nothing even needs to be done.
In our world, I mean, we follow the Fed chair very closely. We follow Fed speakers very closely. But to me, yesterday, and talking, I went out to dinner with friends last night, and they were talking about this. And these are people who don't live in this world. They saw this. This was something that entered the mainstream conversation.
Yeah, I am curious about that. I had several people message me who aren't at all interested in finance in any good way that showed me this video. They're like, "Oh, have you seen this?" And I was like, "Yeah, I lived it." But it gets to the question: do we want that? I mean, like, at what point does it become where it says too much, and it's just it hurts the independence of the Fed, and more importantly, it hurts the ability for them to do their job and do it in a way that's responsible without public pressure.
And I will say Rob Kaplan, former Dallas Fed president, said that basically what's going on inside the Fed is the message of like, put your heads down, let's focus on the fundamentals and let's think about what's the right monetary policy, that's probably what's going on.
Until you're let go or forced out.
He didn't think so. You asked him.
Yeah, he said he would not think that the Fed chair will leave before his term is up in May 2026, but remains to be seen whether he'd stay on the Board of Governors until January 2028.
You know what would be great TV if you and Carol did your show in hard hats.
You got to make sure the hard hat fits properly.
I have been on
Jay Powell's
air.
hard hat was too big.
I have been on air in a hard hat. I've driven a Caterpillar
Oh, really?
tractor and
Okay, I will look that up during
I've
the
done
commercial.
photographic proof of this.
I'm going to look that up during the commercial break, Carol, which we should have taken about a minute ago.
all right,
Okay.
fine. Got to run.
Yeah.
Have a good weekend.
Bye.
All right, that's it. Our cross-platform coverage, folks. Have a good weekend. They're going to continue on TV. We're going to continue on Bloomberg Business Week Daily. We will see you again, same time, same place, on Monday.
Our coverage continues here on Bloomberg Television with a push ahead to big names set to report in big tech next week. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
As we close out the day and close out the week, we do it with a record high on the S&P 500 and the NASDAQ. Modest gains on a daily basis, to be sure, but that has been the grind higher now for the past 6 weeks or so. No real movement in Treasury yields on the day and on the week. And take a look at the VIX. Any concerns about a potential increase in volatility, at least for right now, that's not being priced in. Below 15, that's basically the lowest point that it's been all year long. As far as some of the individual movers on the day, you can take a look at Open Door Technologies. A big pop here on the day, but we should point out, we're talking about a stock that more than doubled last week. This week, it's only up about 6-7%. Tesla also trying to get its mojo back after that 8% drop in the share price yesterday. And take a look at Intel, one of the biggest decliners in the S&P 500 on the day and on the week. And that brings us to our top story, and that's a big focus on big tech. With earnings season now accelerating, a third of the large cap names in the market are set to report next week, and that includes 4 of the 5 heaviest weightings in the S&P: Meta, Microsoft, Apple, Amazon. And as they go, so too does the market. The Mag 7 as a group expected to deliver 15% profit growth. That's good. But the other 493 names in the S&P collectively, they're expected to deliver 0. The disparity tied to big tech's big investments in artificial intelligence and AI trade that is starting to broaden. We're going to hear a lot about AI from some of the healthcare companies that report next week, like Humana, from some of the fintech companies that report, like PayPal, and of course from the chip sector itself. Cadence, Lam Research, Western Digital, KLA, Qualcomm, all on tap with investors looking for some insight into exactly how those companies are going to secure their piece of the AI pie. We want to build on that and bring into the conversation right now a key player in the chip sector. Hassane El-Khoury is the CEO of Onsemi, a big player in the automotive space, a big player in the industrial space, and now trying to make moves in the AI space as well. Hassane, great to have you here on the program.
Thank you for having me. Great.
Before we get to what's going on in AI, I do want to ask you about your core business, or what has been your core business, and that is the automotive sector. And I am curious as to what you've been seeing there with regards to demand going forward.
Look, unfortunately, I can't talk about specific of the demand environment today, as we're reporting a week from Monday. So I'll keep my comment. We're in the quiet period, so I'll keep my comments on the market more on the forward looking. We're still focused on the automotive industrial, and of course we're making our way into the AI, because we're coming at it from a power. If you think about our slogan that we came out with 4 years ago when we set out on the new strategy, we called it our intelligent power. And today the anchor for AI, or the expansion of AI as we want as a country, is really the foundation is in power. And I'm very happy that the commentary around AI also talks about grid and also acknowledges the power, which is right in our sweet spot as Onsemi.
Well, explain to me exactly how you're addressing that issue. I mean, we all know that one of the big limitations to further growth, and really not just growth, but really profitability to some of these AI investments is on the power side. So how exactly does Onsemi address that?
That's a great question. It's a perfect segue into how we look at power into the data center. So if you think about it, you talked about profitability. Profitability is tied to compute power. So you can think about it at a high level, the more compute power we can put in a building or in a data center, the more profit or the more benefit we can get. How do we do that? We minimize the footprint that takes power. You know, think about it this way. Today, if half the rack is used for power and the other rack is used for compute, what happens if we go and do more efficient power that now takes half the size Now 75% of that same rack is going to be based on compute. And you didn't really expand the footprint of the data center. That's the smart power. That's what we have to focus on. Now, I would acknowledge we also need more power because net, we are increasing the compute, we are increasing the capacity, we're increasing more on the data center. So we don't just need more power like the grid and the upgrades that we talk about, but we also need to focus from the wall all the way to the compute and how we can do that much better and smarter.
Well, I am curious, just your own personal view on whether you think some of the money that has been spent with this build out has been done in a smart way.
I think the build out always going to be, there's always the rush, the first adopter, the fast time to market. There's not a lot of optimizations that happen there because you have to also remember the technology itself is moving so fast. You can't wait for the best technology or the most optimal at the time you build it out. So there are time to market trade-offs that we have to make. But now with a concise build out plan, and now as we all know more about how to deploy and the use cases, now we're able to take a step back and say, this is the best way to architect the power in order to get more compute out of the investments. And those are big investments.
Yeah.
The efficiency, you talk 1% efficiency on such a large investment, that is a lot of money.
I am curious if you either directly at Onsemi or if you know of any other folks in the industry that have had discussions primarily with some of the local regulators. I'm talking about the local power regulators with regards to creating more efficient systems. I mean, we've already seen recent power rate contracts come up for renewal at phenomenal prices because of this extra demand. And there's been a lot of talk in certain municipalities about not necessarily having the capacity to meet that demand should it grow much further beyond where it's already gone.
And that's the dialogue we're having as well, because exactly what you said. Of course, we can build out a power plant. We can put a microgrid close to it, whatever source of power you can get. But it's not going to happen in the time frame that we have to build out the infrastructure in order to get to the AI leadership and the AI dominance that we talk about as a country. So therefore, we have to take the step back I talk about and make those investments in innovation. Look, at Onsemi, we saw this coming. We knew that the constraint, the invisible semiconductor, which is power. Everybody talks about AI, talks about compute. But behind every compute, there are hundreds of chips that have to power everything from the grid all the way to the chip. That's what we've been investing in for the last 3 to 4 years. We even acquired a silicon carbide JFET business that is intended to get us that smart power right at the rack. We saw this coming, and now it's there. It's a constraint, and we're here to unlock that constraint in order to achieve the output that we all want.
I am curious about the domestic initiative that we've seen pretty much amongst the federal government to try to sort of make sure that a lot of our chip technology and to a certain extent manufacturing is done here. And I'm curious how involved you've been in those discussions, given the pedigree of Onsemi and obviously the spin out a couple decades ago from Motorola. I mean, this is, to the most part, a homegrown company. This should be a domestic champion. Why don't we hear more about that?
I think now the dialogue is happening. Obviously, we are U.S. based. We are the largest power player in North America, and we are a top 2 in the global scale. So we are here. We manufacture in the U.S. We design in the U.S. And so this is, for us, it's a great opportunity because that's what we want our investment in the federal government to put the focus on. And like I said, I'm very glad that there was mention of semiconductor, there was mention of grid power. But like I said before, we have to also ensure that the deployment of the power is not just more, but it's also smart.
All right, Hassane, really appreciate you taking time for us and hope to talk to you after your earnings in about a week and a half's time. Hassane El-Khoury is the CEO of the semiconductor company Onsemi. We're going to stick with big tech, and when we come back, talk with Dan Ives over at Wedbush about the big slate of tech earnings on tap for next week. This is Bloomberg. All right, investors gearing up for the busiest week of the earnings season, and includes 4 of the 5 biggest weightings in the S&P 500: Microsoft, Apple, Amazon, and Meta. Dan Ives joins us right now, analyst over at Wedbush, to talk about, well, what he expects. And Dan, let's start off, I guess, with the biggest of that bunch, and that is Microsoft. I mean, they've been hitting it out of the park the last few quarters. Does that continue?
They're the Scotty Scheffler of software. And the reality is that, this is a company firing on all cylinders. In the AI revolution, they're really the one benefiting front and center in terms of everything we're seeing on cloud. I mean, I think when it comes to AI and it comes to this next stage of growth, this is going to be a $5 trillion market cap in the next 18 months.
And you're comfortable with the amount of money that they're spending on CapEx and the potential return on that?
You want them to continue. I think they're spending maybe too little. And that's what you saw with Alphabet this week. This is an arms race going on. And Nadella recognizes this is the time, pedal to the metal. Because the demand, we think Street's underestimating demand at 15, 20%. So a lot of the bears, they continue to miss these stories because they're focused on, in those caves in hibernation mode. They can't see AI in the spreadsheets. I think Microsoft's a good example. Some of the parts, and continues to be a table pounder name.
Well, speaking of spending, I mean, Meta has been doing a ton of spending as well. Of course, a lot of headlines about some of the hires, the personnel spending that they've apparently made in order to attract talent here. What do you think Meta's transformation is starting to look like right now? I mean, we've gone from just a pure play social media company to that effort into the metaverse, and now clearly Zuckerberg really sees a future in AI.
Yeah, and Zuckerberg is a wartime CEO right now because he recognizes this is going to be not just the golden age for tech, but when it comes to Meta, that consumer AI revolution, I mean, they're going to be one of the ones leading it. And you start to monetize those billions in terms of from an install base, you're looking at a 4-digit stock in terms of Meta. And that's why it's good money to continue to invest. And I think the street is still, underestimating what this growth cycle is going to look like on the other side. And I continue to believe it's a 4th industrial revolution. And this AI party, it's 10 p.m., it was 9 p.m., and that party goes to 4 a.m.
Where do you think the product cycle is going, particularly for these companies? Is it going to be, in terms of what's going to generate revenue and profitability from this AI investment, is it going to be devices? Is it going to be ads and services that they're attaching to it? Where?
Look, it's the ripple effect. For every dollar spent on an NVIDIA chip, we think there's an $8 to $10 multiplier across the rest of tech. So you think about the hyperscalers, Microsoft, Alphabet, Amazon. Look at Oracle. Look at the renaissance happening names like Oracle. Then you think about the actual use cases, Palantir, Snowflake, MongoDB. And then it also ripples onto the consumer side. Meta, ultimately, I think what we're seeing from Alphabet and others. And that's our view. I mean, we have the Ives AI 30, talks about like 2nd, 3rd derivatives as his 4th industrial revolution plays out.
All right, let's talk about Amazon. I mean, we're going to get their results too, and they're kind of all over the map here. Obviously, we think of them as a retailer, but they're really more, obviously, of a tech company, if you will. Is this an AI story, or should we be looking at it differently?
Oh, 100% AI story. And I think Jassy, he feels like on that AI part, he's on the outside looking in. But I think this is now the velvet ropes open up and they get into that part. This is going to be, I think, the start of a watershed 4 to 6 quarters for Amazon because of AWS and because of what we see when it comes to monetization of the cloud in terms of this next stage of growth. I mean, we think it's $2 trillion over the next 3 years that's going to be spent across enterprise. Amazon's going to play a huge role there.
Any other players out there, Dan, that you think could benefit that maybe we're not paying attention to?
Look, I think when you think about what's happening across AI, I think cybersecurity is going to be a huge beneficiary. Palo, CrowdStrike, Zscaler, CyberArk, and others. And then there's names like Pegasystems, when it comes on the cloud side and in terms of software. I continue to view Akko as our favorite nuclear play. I mean, that to me is the way to think about AI. It's the 2nd, 3rd, 4th derivatives as this all plays out.
All right, Dan, great stuff. Have a wonderful weekend. Dan Ives,
You too.
Global Head of Technology Research over at Wedbush. And we should just point out both Meta and Microsoft report earnings on Wednesday after the bell. That's Fed Day, by the way. And we get Amazon and Apple on Thursday. When we come back, we're talking credit scores with the CEO of VantageScore, Silvio Tavares. Welcome back. Competition is heating up in, well, the industry that we don't really talk a whole lot about. That's credit scoring. The Federal Housing Finance Agency here in the U.S. is broadening its criteria that will now allow Fannie Mae and Freddie Mac, which account for more than half the mortgages in this country, to accept a product called VantageScore 4.0 for mortgage underwriting. Now, there's been a lot of concern here about whether the broadening out to another provider in this space is warranted, and more importantly, whether the old system of having effectively one provider in this space was ever warranted at all. Joining us right now to discuss, I'm pleased to say, is the CEO of VantageScore, Silvio Tavares. Silvio, great to have you here on the program. First of all, I mean, congratulations on getting finally, I guess, your foot in the door when it comes to Fannie and Freddie. I am curious as to, were you working with Fannie and Freddie, with FHFA, I should say, to try to sort of get yourself into this, or was this a surprise?
Well, this was absolutely something which was the product of a lot of work with Congress, with the regulator, and it's resulted in a really important decision to allow VantageScore to compete. Competition is what makes markets great. Information and data is what makes markets great. And, you know, you said there was concern, but the reality is there's been a lot of excitement. We just did a call with leading mortgage players. We had 600 leading mortgage companies on that call. They want to use VantageScore because it's a better score.
All right. Well, I mean, I hate to sort of throw this back at you, but last week we did talk to one of your main competitors over at Fair Isaac, and CEO there, which of course has basically had an effective monopoly in this space for quite some time. He had some pointed criticisms about this expansion. I just wanted you to listen to what he had to say.
Vantage has much looser, more lax credit standards. Their standards for scoring, for example, they'll score on 1 month of data. We need 6 months minimum because we think you can't draw a line with one data point. The challenge is if you have two-score system and people can choose between the two scores and they don't hold the risk because the risk gets passed to Fannie and Freddie and ultimately to the U.S. taxpayer. The risk is you'll have a race to the bottom.
And that was Will Lansing, the CEO over at FICO. We spoke to him last week. Were those comments fair?
Absolutely unfair. You know, our competitor says we ask for less data. We actually ask for more data. Romain, if you got injured and you went to your doctor and you said, hey, can you do an examination, tell me what's wrong? And the doctor said, I went to medical school in 1980. So even though you have an MRI, I'm not going to look at it. Many people would say that's medical malpractice. Our competitor has been doing financial malpractice. They don't look at the relevant data. For example, your rental and whether you paid your rent on time. They don't look at data over time. They only look at the last 6 months. So we have more data, it's more inclusive, and we use modern technology, and that's why our score is more predictive. In fact, your own analysis, Bloomberg Intelligence, which is a different section of the business, they actually published a report this week, and said VantageScore is 15% more predictive. And if you look at our own analysis head-to-head, VantageScore 4 is actually 11% more predictive over time. So that's dead wrong, and it's the reason we're more predictive. That's the reason why over 3,700 banks, 8 of the top 10 banks use VantageScore today, and they're all excited about doing more of that in the mortgage industry.
All right, and we appreciate you giving a shout out. We should point out Erica Adelberg, who leads that team. If you have a Bloomberg terminal, definitely check out her research with regards to this. When it comes, though, to this idea of making sure that a lender is going to feel comfortable, or I guess in this space, Fannie Freddie, but really any lender is going to feel comfortable taking your data or your assessment of the credit risk, of the lending risk. Do you have confidence that you can make the case that what you're providing, what you're putting out there is at least comparable to what FICO is doing, if not better?
Well, the reality is let the data speak. We published data for VantageScore for over 45 million scores over 10 years for the FHFA to make its decision, and we applaud Director Pulte for making this decisive action to allow competition. It is actually the law. 2018, the president signed a law onto the books allowing competition, and we provided the data pursuant to that. Our competitor has not. The question is, why not? Why haven't they provided the data to the public for their score? We have done it, and the data is overwhelming and conclusive. VantageScore not only is more predictive, but it includes many more Americans, 33 million more Americans. And a big portion of those Americans are actually credit worthy, but they were left behind and forgotten. This is your veteran coming home from serving their country. They've been away for more than 6 months. They're not going to have a credit score with FICO Classic, but with us, they will. This is the farmer who counts his pennies, and he wants to make sure that he doesn't incur credit, and so he hasn't done it for the last 6 months. But when he applies for a mortgage, he won't have a score with our competitor, but with VantageScore, he will. So better data, better decisions. That's good for the mortgage market, and we really applaud the director's decisive decision.
Have you had a chance to really think about what this might do for your business in terms of potential growth once this is all fully up and running?
Well, this is clearly a very big deal for VantageScore. We're already the leader in many major segments. Credit cards is one. Another one is consumer display of credit scores. When you log on, for example, to Chase and you check your credit score, it's not our competitor score. It's FICO. It's not our competitor FICO score. It's VantageScore that you see. That being said, this will happen over time. It's not going to be all a big bang. Many of the largest lenders already use VantageScore for one or more of their product lines of business. We have over 3,700 banks, but this is clearly going to drive a huge growth for the business. But quite frankly, we're more excited for the American people. So many new credit-worthy people that are going to get the chance to get their first mortgage. It's really, really exciting, and we're really looking forward to that growth.
All right, and of course, we'll be watching and hopefully we can talk to you along the way as that growth starts to roll out. Silvio, have a great weekend. That's the president and CEO of VantageScore, Silvio Tavares. All right, let's take a quick check here on the markets. We did close at a record high, but take a look at some of the weekly moves here because it does say a lot here about where we might actually potentially go over the next couple of weeks. You saw an S&P 500 close out at a record high, but there was not broad participation by some of the big sectors that actually led us to those record highs. That includes bank stocks, which had a phenomenal run, though ended the week down 3%. That includes the Mag 7, which has had a phenomenal run, but only ended the week up less than 1%. And that, of course, included the phenomenal run that we had in crypto, which sort of petered out this week. Of course, that could change next week in a big way, as we were just discussing with Dan Ives, with a lot of those big mega cap tech companies set to report, including Amazon, which had a 2.4% gain over the last 5 days. This is The Close on Bloomberg. All right, it's a big weekend if you're a movie lover. If you're the kind of person that wants to stay in and chill, well, you got Happy Gilmore 2 premiering on Netflix. And if you're willing to go out, well, you got the Fantastic Four First Steps. That film out in theaters right now. And our next guest says the summer movie season has been on a roll, and it's a roll that's going to continue over the next few weeks, with August looking particularly strong. Joining us right now to talk a little bit more about this is Paul Dergarabedian, senior media analyst at ComScore. Paul, thanks for being here. Let's start off first with Fantastic Four. I mean, we know superhero movies always have this tendency to pull people in, no matter how much we all like to sort of complain about, another superhero movie. But we've seen the success earlier this year with some of the Marvel movies. We saw the success a couple of weeks ago with Superman. What type of success do you think we might see with the Fantastic Four?
Well, superhero movies, Romain, are on a roll right now. And a lot of people earlier on this year were talking about superhero fatigue. I just think it's bad movie fatigue that really hurts movies. And if you look at Thunderbolts, that kicked off the summer of 2025, which did incredibly well and, more importantly, held in week after week. Then Superman, of course, opened with 125 million. This will be its third weekend. Coming up against Fantastic Four First Steps, which I saw last night. I love the movie. And I think that the cadence and frequency of films is driving really robust box office. Some might say, well, you have Superman out there and you have Fantastic Four. How can they both do well? Well, there's a reason, because they waited the correct amount of time between the opening of Superman back on July 11 and now Fantastic Four opening this weekend. That gives enough breathing space between these two superhero movies so that they can both do well. And I think Fantastic Four will have really strong holding power, much as did Superman in that second weekend for Superman, dropping, I believe, about 53% according to our ComScore data. That's a very modest second weekend drop for a film that opened to 125 million.
Yeah.
I'm expecting the same for Fantastic Four to hold in there. We have a great August, as you alluded to, coming up for theaters as well.
So let's talk about the other big film that's debuting this weekend, and it's on Netflix, and that is Happy Gilmore 2. A lot of us remember Happy Gilmore. What I did not remember, Paul, and now I guess I realize how old I am, this movie came out 30 years ago, the original, and they're now just making a sequel to it. How is this going to do?
I feel really old now because I did 30 years, and if you think about the first Happy Gilmore, I mean, even people who weren't into golf love that movie. And, you know, as for Netflix to have this on their platform, you know, making deals with stars like Adam Sandler, providing an outlet for that film, which is not going in theaters, but rather landing on the platform. I don't think the reviews have been that great, but those films, you know, the Happy Gilmore and generally Adam Sandler films were always meant for the fans, not for the, you know, the critics. So it's great. Like you said at the top of this, you can stay home, watch Happy Gilmore 2. You can go out to the theater and see Fantastic Four, or you can do what I would like to see people do both, because it's great to have all this great content, great escape to go to the movies or to watch a comedy on Netflix.
Yeah, and I just have to say, as a huge Adam Sandler fan, the movies don't have to be good. As long as they're funny,
that's right.
That's all I care about. Hey, I do want to get your thoughts deeper into the year, because we've got some big movies on the slate, and it's a lot of remakes, a lot of sequels, Running Man, Predator. I think they're updating, Zootopia once again or something like that. What are you kind of expecting as we get deeper into the year, particularly outside of the summer season and into that holiday box office time frame?
Yeah, and what's old is new again. I mean, we have Naked Gun and Freakier Friday opening in August, which I think are both going to do quite well. I think people are ready for some comedy in the movie theater. You know, we have Adam Sandler on Netflix on the small screen, but comedy in a theater. The Naked Gun trailer with Liam Neeson looks hysterical, as it should. And then you have Freakier Friday with Jamie Lee Curtis, Lindsay Lohan. But then you also have movies like Caught Stealing with Austin Butler in August. You have Weapons, the Zach Krieger film. He directed Barbarian. You've got The Roses. You've got some really interesting movies. I call August the punk rock month because past August releases, Apocalypse Now, District 9, and Inglourious Bastards, the first Guardians of the Galaxy movie. And then beyond that, we have a new Wicked movie on the way, Wicked for Good, an Avatar movie, Avatar Fire and Ash, The Running Man, as you mentioned. So a lot of great stuff out there on big screens that are in theaters now and coming up.
Hey, real quickly, though, on Caught Stealing, I mean, this is like one of the few movies that I think has been talked about that isn't a sequel or part of some, long-term, franchise. How do you think that's going to do? I mean, what is the appetite for that right now?
Well, I think there is an appetite for it, but we're not expecting the film to open to 100 million. But when you have Darren Aronofsky and Austin Butler and movies like that that are very filmmaker-centric, that's where you want to put an edgier type of film, which is still within the framework, the timeline of the summer movie season, which runs from the first Friday in May through Labor Day Monday, accounting for those 18 weeks, close to 40% of the full year domestic box office, according to our exclusive ComScore data. So this is a big deal. The summer movie season, we're on a roll right now. We're up 15% over last summer. The year is up 14% over last year, year to date.
All right, Paul, great stuff. Have a great weekend. Hope you see something good. Paul
I'm going to.
Paul Dergarabedian, he is Senior Media Analyst over at ComScore. All right, when we come back after the break, we're going to take a look back in history, a look back at the nomination of Paul Volcker to lead the U.S. Federal Reserve and the ensuing political pressure to try to force him out. This is Bloomberg. All right, let's take a look back at this day in history, July 25th, 1979. That's when President Jimmy Carter nominated Paul Volcker to lead the U.S. Federal Reserve. It was a hasty choice, sparked by Carter's own economic malaise speech just 10 days prior and a cabinet reshuffle that ensued in the days after. Hasty as it was, Volcker would prove to be the right choice at a time when consumer inflation had doubled to 11% and rising. Now, Volcker, who had helped President Nixon devise a successor to the gold standard in the early 1970s, became better known in the late 70s for his fiery advocacy of monetary restraint while heading the Fed's regional bank in New York. In one of his most notable speeches, Volcker lamented that this powerful economy of ours will simply not work smoothly or at anything like maximum efficiency or output when there is pervasive uncertainty about the price level. Volcker's confirmation as Fed chair in '79 was swift, but the incremental rate hikes he ushered in had little impact on runaway inflation. So Volcker, he decided to go for shock and awe. In a press conference that markets dubbed the Saturday Night Special, Volcker, on October 6, 1979, told the nation that the Fed held an unscheduled meeting deciding to lift rates a full percentage point to 12% and adjust its policy directives to focus more on limiting money supply growth. The changes, they would push Fed rates eventually above 20%. It was painful, but effective, and not without political controversy. President Carter lost re-election largely due to that economic pain, and his successor, Ronald Reagan, tried to force Volcker to be more dovish as the rate hikes contributed to 2 recessions, a 10% jobless rates, and soaring loan defaults. Congress even went so far as to introduce legislation requiring the Fed to cut rates. Now, that bill failed, but the political pressure stuck. But Volcker, he stayed the course. Ultimately, his tough love was vindicated. Inflation plunged from 15% in 1980 to under 4% by '83, and the refocus on money supply, that helped lay the foundation for the global economic boom of the 1980s and 90s, making Volcker the most consequential of the 16 people in history to lead the Fed, from Charles Hamlin in 1914 to Jay Powell today, and providing a valuable lesson that maybe sometimes you just have to let the Fed do its job. And that does bring us to today, where the President of the United States continued to double down on his calls for lower rates. On the heels of that visit to the Fed's renovation site yesterday, Trump today saying that the Fed chair all but indicated he would start recommending rate cuts. Take a listen.
We had a very good meeting on interest rates, and he said to me, now I don't know if he's going to say this on Thursday or whenever he speaks, but he said to me very strongly, the country is doing well. He said, congratulations, the country is doing really well. And I got that to mean that I think he's going to start recommending lower rates.
All this coming, of course, just a few days before the Fed's set to have its next policy meeting. David Wilcox, who spent some time in that building, joins us right now. He's now an analyst for us at Bloomberg Economics. And David, I think we've all been a little rattled at just how much of a pressure campaign, an organized and coordinated pressure campaign that we've seen on the Fed and Jay Powell. But ultimately, my main takeaway is that it does not seem to be having any real tangible effect, at least not one that we can see.
The pressure campaign, Romaine, really is unprecedented in U.S. history. It is teaching Donald Trump a lesson that is very frustrating to him. And that lesson is that when Congress redesigned the institutional structure of the Federal Reserve in 1935, they did a really good job. With deliberate intent, they created a Fed that was one step removed from the political fray precisely so that it could make monetary policy decisions in the longer-term interests of the nation. That's what we're seeing right now. Donald Trump is not used to confronting a situation where he can't bend the key personnel to his will. That's what he's discovering today, both as a reflection of Jay Powell's discipline and character and dedication to the mission, but also because of the legislative structure of the Federal Reserve System that was put in place 90 years ago.
The system is certainly being tested, and at least for right now, David, it does appear to be holding up. When it comes to the individuals, and you've had a chance to advise 3 Fed chairs in the past, you spent several years leading their research department there. Maybe you could give us some insights into how seriously that the individual Fed chairs do take the responsibility they have to carry out that dual mandate and to do so without giving in to outside pressures.
I think it's a little hard for people outside the institution to fathom just how devoted, just how simple the devotion is to doing the job that has been given to the Fed by the Congress. It really is baked into the ethos of the organization. When Powell says maximum employment and price stability is the job they're given to do. That is a clear and accurate reflection of the conversation that goes on inside the building throughout the working day. It's what drives the staff, the policymakers, and the overall institution.
Powell is going to have to get up on that podium on Wednesday as normal after the Fed meeting and give his press conference. No doubt about it, he's going to be peppered with multiple questions about his future, particularly in light of the optics of what happened yesterday. How does he handle that, David? What does he say? Does he just avoid the question?
I think what he does is execute exactly the playbook that he's been using, which is, I'm not going to get into the day-to-day political fray. What I'm here to tell you about is how I and my colleagues on the Open Market Committee are remaining dead set focused on the mission given to us. That policy mission is to promote maximum employment and price stability. And he's going to be very non-responsive, I think, to questions that stray from that core subject material.
All right, David, we have to leave it there. Really appreciate it. David Wilcox there, who leads our economic research for Bloomberg Economics and formerly was the director of the Federal Reserve Board's Division of Research and Statistics. As we push ahead to next week, as some of the big market moving events to keep an eye on, of course, the premier day will be on Wednesday. That is Fed Day. The Fed will make a rate decision. No moves expected in rates themselves, but of course, a lot of questions about what the Fed will telegraph going forward, not only about rates, but about Jay Powell's future. Also, we're going to get a ton of earnings all week long. On Tuesday, we get earnings out of names like Boeing, Starbucks, and Visa. On Wednesday, we get it out of a couple of the Mag 7 names like Microsoft and Meta. And then on Thursday, Amazon and Apple report, as does Samsung, which could provide some insights into what's going on overseas. And don't forget, a lot of economic data as well. An update on the PCE data here in the United States. And then, of course, on Friday, we get two big events. We get a U.S. jobs report, that monthly U.S. jobs report on August 1st. And of course, that also is the deadline, the self-imposed deadline that the President of the United States has given various nations around the world to strike a trade deal with the United States. We'll be back next week. Please join us on The Close for all your market-moving coverage. For your politics coverage, Balance of Power is up next.